Hey, how's everybody doing? Welcome back. Today we're going to take a look at Series I bonds versus 30-year bonds. Okay, this is an exciting time. Yes, the stock market and the bond market are struggling, but it's been a long time, maybe 15 years since bonds have been this interesting. All right, we're starting to see yields over 4%. So if you can get a yield over 4% in the bond market, why would you buy dividend stocks, right? So there's a question. But when we get into the bond market, Series I bonds versus 30-year bonds. Okay, so let's take a look. Okay, so the first thing I want to cover is that Series I bonds and 30-year bonds are different. They go up for different reasons. Okay, now let's go into that. So here it goes. So Series I bonds move along with inflation. Okay, so when inflation's high, that's based on the economy. Series I bonds go up. Like now, they're at 9%. 30-year bonds are based off the Federal Reserve rate. So the Federal Reserve sets a rate, say 3%, and then all the different treasuries fall alongside that because the bond market is bidding against that federal rate. And for the most part, bonds don't go below that federal rate. So the federal rate's 3%. Then the 2-year might be at 3.2, and then the 10-year might be at 3.5, and then the 30-year might be at 4%. Right, in a perfect world. That's not without an inverted yield curve, which I won't go into. Okay, so they're going up for different reasons. Right now, they're both going high. Series I bonds and 30-year bonds are both going high, but for different reasons. Okay, so that's something to remember in the long term. Now, Series I bonds don't pay you, they compound. All right, so you purchase a Series I bond for, say, $500. That $500 compounds upon itself for 30 years. You take it out, maybe you have, $1,100, $1,200, right? And then you pay taxes on the difference. 30-year bonds pay you. So over those years, you buy a $10,000 bond at 5%, whatever that is per year. You get that twice a year, and then you can do what you want with those payments. Now, this is where things get interesting with 30-year bonds. Okay, you can reinvest those interest payments if you're very diligent and not spending that money. But if you're reinvesting that money, say you get $200 every payday from these bonds. If you reinvest that into preferred shares at 9%, USDC at 9%, whatever, dividend stocks at 8%, whatever. So if you're taking that money and reinvesting at higher yields, in the long run, it's going to pay off much more dividends than the Series I bond. But you got to be diligent, right? You have to be diligent. So if you look at it like that, like, okay, hey, it's my goal to keep reinvesting this interest, right? And then those payments will start compounding upon themselves. You buy $200, so you buy 8 preferred shares, and then they pay you whatever, $3 every quarter, right? Something like that. And then that's the money you spend. It is what it is. Like, you have to be very smart as an investor, right? It's like a little spider web of investments. But if you get that mindset right, you're doing it right. So we don't know what inflation holds for us. We don't know what the economy, Federal Reserve, right? Things, everybody's freaking out, everybody's scared. It is what it is. My main thing is I don't make money on the stock market, right? Yes, I get a yield, but my goal in life isn't to make money on the stock market. It's to make sure my money is growing. Okay, right now my stocks are down, but that's okay, right? Because I'm more worried about real estate and writing books because that's where my money is, okay? Because that's pure income, right? Renting rooms and writing books is pure income. I could wake up, create a book, it sells $6, whatever it is, whatever I get, all that money comes to me, right? That's a pure income, okay? The stock market can't affect that. Sorry, there's a plane. Sorry about that. There's a plane. There's a air show going on in San Diego right now, so I need to be quick, okay, before they start. All these blue angels start flying over my head. Okay, so right now, if I had $500 to invest per month, I would split it between Series I bonds and 30-year bonds. We don't know what's going on, but as 30-year bonds hit 6%, you can't. The Series I bonds aren't going to be high very long, right? I give it another 2 or 3 years, and they're going to be back to 2%, 3%. right? So those 30-year bonds, if you get bonds, 30-year bonds at 6%, they're gonna be worth a lot of money. Again, I'm not gonna say sell, but the way bonds work is if you have a bond at 6%, and let's say interest rates, Federal Reserve rate goes down to 1.5% or zero, your 6% bond is worth a lot of money, right? And people are going to bid that thing up. So if you paid $500, somebody might pay you $600 to buy it, right? That's how bonds work, right? Similar to dividends or no different. Okay. So if you don't understand anything about bonds, I highly recommend reading the bond book, right? Yeah, links in the article. Because you need to understand that I'm not going to be buying and selling bonds, but it's good to know, you know, as I'm purchasing how much my 6% bonds are going to be worth later on, right? Before I read the book 3 years ago, I bought a lot of bonds at like 1.5%, 2%, right? They're worthless now. Okay. But I'm not selling them. So I didn't lose anything, right? I didn't lose my capital. So I'm good. But it's good to understand, right? It's good to understand when the best time to buy bonds are. With that being said, we don't know what the future holds. Series I bonds are always going to be a good investment. You can't lose money on Series I bonds. You can't lose money on 30-year treasuries if you don't sell, right? So you can't lose money. You're gonna get whatever you bought for. So you bought it at 3% and you keep it for 30 years, you're gonna gain 3%. And there's nothing wrong with that. Okay. You don't follow the news. They're gonna tell you you're a loser for, not maintaining your preserving your capital, or you could be smarter. All right. Do what works for you. Okay. Adjust your own risk level. A 3% 30-year bond, there's nothing wrong with that. Okay. Yes, you're going to lose some money versus inflation, but you're not going to find a 10% bond anytime soon. Okay. So we're all going to be losing money. All right. And so what we had to do is adjust our rest of our lifestyle against inflation. Okay. It's not about trying to beat the market because you're too risky. It's better to coupon, go out less, rent rooms, start something else to make money, start a profession, start a hobby where you can make money, start a blog, right? Those are all things you can do to beat inflation. Those are the real ways to beat inflation. Don't try to turn to an investment as a sole source of beating inflation. Okay. Because now you're putting your money somewhere else, right? The best person you can bet on is you in your mind. Okay. So you can figure it out. Okay. Prices go up on food, eat less. There's nothing wrong with eating less, right? So these are all important things to do, right? Okay. So with that being said, go download these books, of course. Business. I just finished how we plan to retire on dividends part 4. That's coming out tomorrow. Good times for everybody. Let's go back and look at this. I chose this book because I've been selling a lot of hard copies on this, a lot of paperbacks, right? So this is a good book. People are really enjoying it. It's very vital today, right? So I've been selling paperbacks on this one recently. So people are interested in these Series I bonds versus 30-year bonds, right? Those 4% yields. So get on it. And with that, I'm out of here.